Hey traders, a very warm welcome to you. So, a bit of an unusual one perhaps, and not so frequently talked about in outside of the US, but what is an ETF? An ETF is called an exchange traded fund. Okay, let's talk about exactly what it is and how useful it is for us or not. So, an exchange traded fund is a basket of stocks or a basket of assets wrapped up and priced as one item. Let me explain. So you would have something like SPY, which is the S&P 500 ETF. So it's an exchange traded fund that tracks the actual movement of the S&P 500. The S&P 500 goes up 1%, this will go up 1%. The S&P 500 goes down 2%, this will go down 2%. That's pretty much what happens. So why would you buy this and not the S&P 500 futures or 500 stocks? Well, there probably answers my question straight away. It is much cheaper and more cost effective to trade this SPY's ETF, the S&P 500 ETF, than it is to be buying futures generally. So if you wanted to buy S&P 500, you have to either buy futures and you have to roll them over. You'd have to allow different, the different value of futures, the notional value is different to your stocks. There's a lot of things that go into there to make a decision. Or you buy 500 different stocks, you've got to pay the spread on all, quite an expensive thing to do. Or you can buy this SPY ETF called the Spiders, which tracks the S&P 500. And the good thing about this one is you can buy as much or as little as you like. If you want to buy one share, you can buy one share. You'll unfortunately, if you go in the S&P 500 futures market, you've got one contract's the minimum you can do, which has got quite a big notional value. And the same, you can't buy one of each stock, because you're going to get a skewed amount. It's not going to be the same. It's going to be unuseful for you. So cost effective, easy, cost effective. And it's very easy as well for larger funds to hedge positions. They can say, listen, I've got, 10 stocks. My pen's running out a little bit here. Let me try the red one. I've got 10 stocks in my portfolio. My exposure is 10 million, for example. Let's say 15 million. Let's not get anything's confused. There's $15 million, and I want to hedge that position for the next month for whatever reason. I can literally sell $15 million worth of S&P 500. Very, very easy. It will work out the amount of shares I want. I've now got a lovely neutral hedge on what I want to do. So it's easy to do, easy to trade. It's reasonably cheap to do. There is some expense in there, and there's some kind of costs involved as the thing gets rolled over. There's a little bit of expense is taken out of it, but on the whole, it's cheaper to do than the alternative. Okay, let's have a look now at another one. I'm looking at my notes here. Okay, another one we could do which is another benefit of the ETFs, is that we can get exposure to things that are very difficult to get exposure to otherwise, perhaps. So we can have groups of commodities, for example. USO is an oil tracking ETF. And so if we wanted to track the price of crude oil, we could do that, put it in our stock portfolio, so it's treated as a stock because we're buying an ETF, as opposed to having to buy futures, having to worry about delivery of the oil, having to roll over the futures contract, having to look at far months, front months. USO is built up of different months. It's got a lot of front month. I'm not quite sure on the weighting. Somebody can stick it in the comments below if you're familiar, or have a look on Google if you're more interested. But USO contains most front month contracts, some far month contracts, but they do it all for you. That's the point. You're buying this stock or this exchange traded fund. I keep calling it a stock. It's not. It's priced as a stock, just as a stock would be. You put it into your broker, and it would get this just quoted as a stock. There's a small management fee which is included as a rollover, but ultimately it saves you having to buy, some front month, some far month. Maybe you buy the wrong month and it goes into contango and there's some sort of supply issues that affect something, but the price of oil goes up or what have you. It's just, a nice convenient way of getting exposure to something without having to do a lot of legwork or having to put a lot of money down. You can get exposure for a couple of $100 worth, a couple of $100 worth of oil exposure. You buy USO. You can't do that because one contract's 10,000 barrels off the top of my head. Again, someone correct me, of crude oil, which is CL code on NYMEX. It's going to be, or maybe it's 1,000 barrels actually. it's going to be very much more expensive for you than doing it without. So cost effective, easy, and pretty simple to do, cheap. And this is why they've taken off so much. Anyway, next video, guys, I'm going to talk about some of the main ones that people trade, some of the constituents of each of the main ones, what the ones we can perhaps look at, and also some of the unique ones as well that are sometimes worth watching. Take care, guys. See you in the next one. Bye-bye.